In this session, I am going to focus primarily on the Black-Scholes option pricing formula. Earlier, we have looked at the binomial tree-based option pricing formula, which was more and more appropriate when we looked at the discrete time intervals, because we talked about change in 3 months, change in 1.5 months. So we are expecting that the stock price will change in discrete times and discrete state spaces. We talked about only one or only two possible values. Let's say from this, after 3 months, the price could be either this or this. So only two possible values. So we have operated in discrete states. But in reality, what we are going to observe is the stock price can change more or less in a continuous time, and even it can take any value. So state space also could be more and more continuous. So it's as good as probably increasing the number of periods in a binomial tree can approximate can be approximated to a continuous time. So probably instead of 2 period tree, probably if I talk about 200 period tree, probably that is where we see that the discrete time interval is approaching the continuous time. Discrete state is approaching the continuous state space. So that is one major improvement that is coming as a part of the Black-Scholes formula. This is primarily assuming that the stock price change is operating in a continuous time as well as in a continuous state space. So that is what is a reflection more of a reality, right? We are coming closer to the reality. And when we talked about the binomial tree based model, we have simply said that the stock price is going to follow a random walk. Stock price follows a random walk. Now, the same logic, when I am taking it to a continuous scenario, the same random walk is getting translated into Brownian motion. We have looked at it earlier. In case of continuous, the equivalent of a random walk is nothing but a Brownian motion. So that is where we say the stock price is going to follow a Brownian motion, and these people, Black and Scholes, in deriving the formula for the pricing of the options, they have taken the situation that the stock price follows a geometric Brownian motion, because stock price can never be negative. We have seen earlier that a regular Brownian motion over a long periods of time can make the value to take negative values, whereas the stock prices generally can't take negative. And that is where in the Brownian motion category, the geometric Brownian motion is being considered as an assumption for building the price of the derivatives. So this the entire Black-Scholes formula that I am discussing here. It is going to follow a no arbitrage kind of an approach. The no arbitrage based portfolio is what we are going to create to evaluate the worth of this Black-Scholes based option pricing. So no arbitrage portfolio is as good as the creation of a risk-free portfolio. So whatever goes into the creation of this risk-free based portfolio, we are going to derive the formula for computing the price of the call option as well as put option. But before getting a little bit more deeper into it, let's start off with the understanding of the base assumptions that Black and Scholes have typically made in terms of creation of the formula, and how realistic are they to the real world. They have made a few assumptions, that the underlying share, whatever the stock price, whatever is the share price, it follows a geometric Brownian motion. But what is the reality in this context? The share price need not follow a geometric Brownian motion. We have seen or in real world we keep seeing situation where the share price change is not smooth, is not continuous. Generally, we see that the share price actually follows some kind of jumps. Suddenly, because of some news, there could be a sudden hike or a sudden fall in the price of the share, which mean the smooth geometric Brownian motion may not be really applicable. But yes, it's a decent assumption to be made, though there are some kind of loopholes that are associated with it. And when I am talking about it following a geometric Brownian motion, first of all, the geometric Brownian motion itself operates in continuous time, continuous state spaces, and we have seen earlier that the the change in the stock price DST goes with ST times some drift factor times DT plus the standard deviation, which is the volatility factor that follows a standard Brownian motion. So DST generally is given with this if we are going with a geometric Brownian motion kind of a principle. And one more assumption that Black-Scholes have typically made is no arbitrage opportunities. So even if they are there, they are very quickly used up. The investors or the market is sizable enough to exploit all the arbitrage opportunities that come in the way. So which means there is no arbitrage opportunity that is readily available, right? And they have typically made one more assumption that the risk-free rate of return R is generally constant for the entire maturities. For all maturities it is constant, and for borrowing and lending also it is constant, right? They have actually created this kind of an assumption that R is constant not only for borrowing and lending at any kind of maturities, but in the real world we all agree that the borrowing rate and the lending rate are always different. They need not be the same, and the interest rates, typically the risk-free rate of return, which we are talking as interest rates, generally they change drastically and probably in a non-predictable manner also. They are completely unpredictable also in some of the cases, though I can use a lot of interest rate prediction models, but even the way they change is completely unpredictable, which means probably in the long run R may not be constant at all. Probably if I am looking at it over a very short term period, this assumption that R being constant is still fair enough. But when I am looking at it in the long run, probably it may not be possible at all. So that's one more dimension that we are more interested in looking at. One more assumption that came as a part of the Black-Scholes formula derivation is unlimited short sale. Unlimited short sales is possible, means people can hold the negative units of a particular security. There are no restrictions on it, but generally it is done through various repo agreements, repurchase agreements, but most of the cases there could be a lot of restrictions. In reality, there could be lots and lots of restrictions for unlimited short sales. There could be huge costs Even if they are allowed, the costs that are incurred with respect to holding short positions could be much higher. But of course, if a combination is used with respect to the derivatives, there is some kind of a possibility that these positions can quite comfortably be replicated. But one more assumption that came up regarding the derivation of the Black-Scholes formula is there are no taxes, no transaction costs. Very important part, because people continuously get into buying and selling processes to create no arbitrage portfolio or zero risky portfolio. But if there are no transaction costs, that is fine. But in reality, because of the transaction costs, these arbitrage opportunities may not be exploited. They are just ignoring the arbitrage opportunities, because the transaction costs could be much higher, right? So more and more transactions occurring, more and more transaction costs, which means we are not eliminating the risk in all the cases, because transaction costs are there. I don't want to take the opportunity of reducing the risk because it will increase my transaction costs, which means the portfolio that we are creating is not always a zero risk portfolio. It's not risk free in entirety, right? And so which means regular rebalancing is not possible in the real time. And the other important assumption that have come out is whatever the underlying asset which we are talking of, there is a continuous trading for it, right? Whenever there is a mispricing, people try to exploit. There is a continuous trading for it, and it can be traded in infinitesimally small units. Again, that's not a possibility in the real world. It cannot be traded in 0.1 share, 0.002 shares kind of stuff. The minimum unit is 1 share. So even in reality, that breaking down of the share to that kind of a smallest possible level is not possible in the real world. So all these assumptions that have been made, to some extent they violate the reality, but at the same time what we are saying is they are the best enough the Black-Scholes model that has been derived using all these assumptions is the best available model even today when it comes to meeting the market prices of the derivatives more and more to the reality. And all these will typically are going with another major assumption saying that the stock market is complete. So what do I mean by stock market is complete here? Any derivative which we are talking of, any derivative, whatever is the payoff that can be associated with the derivative, I can replicate that payoff quite comfortably using the stock and cash. So when I am saying the market is complete, I am able to replicate the payoff of the derivative quite comfortably. And so whatever we are saying, a few assumptions that we have made, even the jumps that are existing in the stock price, so the geometric Brownian motion may not be possible, the entirely risk-free portfolio cannot be possible, but the derivatives can really help me to reduce the risk. They may not be able to eliminate the risk in totality for me, but they are playing a decent role in terms of reduction of the risk. And similarly, when we are going with unlimited short selling, yes, I can use the derivatives to reduce the scenario of short selling, because I can take short positions in the derivative. But when we are talking about the assets infinitesimally small, which cannot be possible in the real world, which means I cannot eliminate the risk again, but I can definitely reduce the risk. So even though there are so many assumptions which are violating the real world scenario, what it is being coming out is when we try to compare, when I try to compare the option price, whether it is call option or put option, the option price that is generated by Black-Scholes formula and compare it with the market, with the real world market price, to a large extent there is a kind of a decent correlation that is coming up between the two. So there is a good approximation that is coming up between the Black-Scholes generated price versus the original market price. So that is why the Black-Scholes formula, despite of all these assumptions which are far away from reality, this is able to create a kind of an impact in terms of the usage, in terms of its usage for pricing the option. So whatever the model that is coming out, it is able to solve a particular problem in terms of providing us the solution for pricing the option. The prices whatever are coming out through this Black-Scholes mechanism, they are close to what we observe in the market. And with this kind of a help, probably it is opening the doors for us to perform a lot of dynamic hedging using the derivatives in a quite comfortable manner. That is one of the prime reasons the Black-Scholes formula is carrying a lot of impact in the derivatives market. So with that as the base, now I would like to look at the construction of the Black-Scholes formula, or probably on what basis this Black-Scholes formula has actually come up. So the intention of this Black-Scholes formula, first of all, is it is used only for pricing European calls and puts. It's not applicable to the American options in a straightforward manner, and under the assumption that the share prices are following a geometric Brownian motion, continuous time and continuous state space is where they operate. So whenever I'm looking at the European call option, and because the share prices are following a geometric Brownian motion, I can say that the change in the stock price is going something like the stock price multiplied by mu dt, which is a drift factor with respect to time, and a volatility factor which is following a standard Brownian motion. So this is the kind of an expression that is going which can that is going with respect to the geometric Brownian motion, from where it can be simplified to st is typically st is coming out as s naught into e to the power of mu minus half sigma squared into t plus sigma zt. Right, probably if we really want to know whether this is what is coming out this, we could very well differentiate this. We can take a partial differentiation of this using the Itis lemma and try to see whether the solution to this particular differential equation is this or not. So what we typically say is investors are going to invest some amount in this kind of a share, and also they are holding some amount in a risk-free cash bond. So the risk-free cash bond, probably if I am denoting it by BT, then probably the return that is coming up is a risk-free rate of return. So the change in the price of a risk-free bond in time t is coming to be r times bt dt, which means the solution for this is working out to bt equal to b naught times e power rt. Now, Probably just to test it out, if I want the solution for this, I'll typically go for solving it as a differential equation. So I'll take it as d of t comma st, because it's we are talking of two variables, time and the state. So if I take the expression s naught times e power mu minus half sigma squared t plus sigma zt. We know that, this I have to take the derivative assuming that this is the function t comma st. I take the derivative of this particular one. So if I have to take the derivative of that, we know as per the Itis lemma, we are talking about derivative of t comma st, derivative of some function, some f of t comma st. I am taking it as dou f by dou t, first one. I am differentiating it with respect to time, multiplied by dt. Then I am taking dou f by dou st. I am multiplying it with dst, and half dou square f by dou st squared multiplied by dst squared. This is what is the Itis lemma. So using this, now the first one, if I have to, so I'll use this particular Itis lemma, wherein I am taking f of t comma st as s naught into e power mu minus half sigma squared t plus sigma dzt. So the first one, when I am taking dou f by dou t, dou f by dou t is coming out to, if I am differentiating this with respect to t, so this entire thing is operating out with, if this entire thing is operating out, I'll take it as the same st, right? Because s naught into, if I'm taking the derivative of this with respect to t, I'm taking this entire thing. So s naught into this is coming out to st, and the derivative of this e power with respect to t is coming out to mu minus half sigma square. Mu minus half sigma squared is what is coming out as the derivative of this with respect to t. Then the same logic I can do dou f by dou st, or probably here I am taking it as dst itself. Dou f by dou st, or let me take it as zt across. So dou f by dou st, when I am taking it, st is like a standard Brownian motion here. So if I am taking it as dou f by dou st, then it is coming out to sigma, right? I'm differentiating it with respect to this. I'm getting it as sigma. This is dt, then this is dst, and finally this is coming out again. If I'm taking one more derivative, sigma into sigma, it becomes half sigma squared dst squared. So this is what is typically coming out. Now I can very well look at dst squared, right? Dst squared is coming out to dt for me. So it is working out as st times mu minus half sigma squared into dt plus sigma times dst plus half sigma squared dt. So this term is getting cancelled off with this term, so working out to st times mu dt plus sigma dst. This is what we have arrived at when we initially talked about with the geometric Brownian motion. So which means that the solution to this particular differential equation is coming out to be S naught into e power mu minus half sigma squared t plus sigma dst, right? So this is where we are calling, when we are using the Black-Scholes formula, the differential equations wise we are using it as following a geometric Brownian motion. dst is going as st times mu dt plus sigma dst. So this is what is coming out dzt. This is what is coming out as a standard Brownian motion, and what we are dzt. This is what is coming out as a standard Brownian motion, and probably when we are typically talking about dbt, we are talking of rbt dt. Now using this, the Black-Scholes formula typically that has come out, assuming the current share price being st, t being the time to maturity, and x being the exercise price, it has come out that the price of the call option, European call option, the price of the European call option is coming out to st times the normally distributed value of d1 minus x e power minus rt times the normal distribution, continuous normal distribution function associated with d2. And from here it came out that d1 is nothing but log st by x plus r plus sigma squared by 2 into t, which is the time to maturity, divided by sigma root t, and d2 is coming out as d1 minus sigma root t, and whatever nd1 and nd2 that I have talked of, they are the cumulative distribution values that are associated with the standard normal distribution. And in case of a put option, the same logic is coming out as x e power minus rt n of minus d2 minus st into n of minus d1. This is what is coming out as the price of the European put option. So one, from a numerical solving perspective, probably I can take these things directly into a spreadsheet and try to compute the price of the European call option or the European put option. But in case we require the derivative for the same, or in case we require the derivation for the same, then probably we can use the Itis lemma and try to get into the derivation for the derivation for the option price itself. See, we have already discussed that the value of the function tst using the Itis lemma, I take it as dou f by dou t multiplied by dt. Then I am taking it as dou f by dou st multiplied by dst plus half dou square f by dou st squared dst squared. Now I know dst for me, we have already worked out dst is nothing but mu dt plus sigma dzt st times. So if I am doing the squaring of dst squared, it is nothing but st squared multiplied by mu square dt squared plus sigma squared dzt squared plus 2 mu sigma dt dzt. This is what is the expansion. We know dt square is 0, dzt square comes out to dt, and dt times dzt is also 0. This we have seen earlier as a part of the expansions. So this entire thing is coming out to st squared sigma squared dt. Right? This is what is the dst squared. So using this, now again I am finding out the formula df t comma st dou f by dou t. So this is working out as dou f by dou t dt plus dou f by dou st dst. dst I could very well write it as mu dt plus sigma dzt times st plus sigma half dou squared f by dou st squared dst squared is coming out as st squared sigma squared dt. So I could bring all the dt terms to one side. So this is working out as dou f by dou t plus dou f by dou st times mu st plus half sigma squared st squared dou squared f by dou st squared. This entire thing multiplied this entire thing with dt, and when I am talking of dzt I am getting it as dou f by dou st sigma st dzt. This is what I've got, sigma st dou f by dou st. So this is what I've got here. Now all I could now this is what is an expression that is very much important for me. So let me write down that expression. The df of t comma st is typically working out to me as dou f by dou t plus mu st times dou f by dou st plus half sigma squared st squared times dou square f by dou st squared. This entire thing times dt plus sigma st dou f by dou st times dzt. This is what is typically coming out. Now I am talking about the creation of a risk-free portfolio. I'll create a risk-free portfolio where I am saying I'll short one derivative, which means minus one derivative, and I'm going with dou f by dou st number of shares. Right now, dou f by dou st number of shares. So which means the value of the portfolio is typically coming out as minus f of st comma t, which is the shorting in the derivative, plus I have gone with dou f by dou st number of shares. So the value of the portfolio is going to be something like this: dou f by dou st times st, whatever is the number of shares that I have typically taken. Now I want to see the change in the value of the portfolio, which is coming out very comfortably as minus df of st comma t plus dou f by dou st dst. Now we have already seen d minus df. So looking at this, minus df by minus df st plus dou f by dou st dst. So simplifying, okay, this is the minus part, right? This is the minus part, and we have already seen dou f by dou st if I'm going with dou f by dou st dst, I know dst is nothing but st times mu dt plus sigma dzt. So I'm able to see that sigma st dou f by dou st dzt, the negative of this and positive of this are going to be cancelled off, and I'm also seeing the negative of mu st dou f by dou st plus mu st dou f by dou st. So this and this are getting cancelled off. So the value of the derivative, or probably the value of the risk-free portfolio, is coming out as minus dou f by dou t, and it is working out as minus half dou square f by dou st squared into sigma squared st squared. This entire thing with a dt term. Now there is no dzt term in this at all. So because there is no dzt term, I am very much sure that whatever is the change that is coming up, right, whatever is the instantaneous change in the value of the portfolio, whatever is the gain or the loss that is coming up in the value of the portfolio over a short interval, that is completely risk free. There is no, the whatever is the change, that is an assured change because it's changing with time, but there is no random component that is coming into it. So the gain or loss that is coming up in the portfolio is coming out to be this, and which is more and more risk free. So from that dimension, I can very well equate the same, because this is going to be more and more risk free. All I could very well go it with is this. I'm looking at it as a risk free rate R. If I'm going with a risk free rate R, this is going to be as simple as R into the value of the portfolio times dt. So this directly I could take it Vt, we have already taken it to be this particular value minus fst. So V, I have taken it to be something like this. So this is what I could directly equate this to, because my portfolio is nothing but minus f plus dou f by dou st times st. So I'm equating all that stuff. So which means the calculation is coming out as minus dou f by dou t minus half sigma squared st squared dou square f by dou st squared. This I can very well equate it to r times minus f plus I've taken dou f by dou st shares into t dt. So doing a small adjustment, bringing out all these things to this particular side, it is becoming dou f by dou t plus dou f by dou st times st into r plus half sigma squared st squared dou square f by dou st squared, this dt. This entire thing is becoming equal to rf dt. So this is where I'm able to operate out saying this particular dou f by dou t actually is called as theta, the change in the value of the option with respect to time called as theta. Dou f by dou st is actually called as delta, the change in the price of the option with respect to the change in the stock price. So delta st into r plus half sigma squared st squared. We are talking of dou f by dou st, dou squared f by dou s, dou square dou st squared, which is coming out as gamma. So this is what is the typical differential equation, the partial differential equation that is associated with Black-Scholes. And by using appropriate boundary conditions, which are like the maximum value of this derivative is somewhere between 0 and probably st minus k if it is a call option, k minus st comma 0 if it is a put option. Using that, doing a simplification of this partial differential equation, we can very well derive the price of the call option. So typically we can call it as theta plus rs delta plus half sigma squared st squared gamma is equal to Rf. This is what we typically call as the partial differential equation with respect to the Black-Scholes formula. And probably the other way I could see, if the particular portfolio is delta hedged as well as gamma hedged. If it is a delta and a gamma hedged kind of a portfolio, we see that this is 0, this is 0. Then whatever is the change in the price of the option with respect to the time is purely a risk-free rate of return itself. So that's one more dimension that is typically getting built up as a part of the formula. So this is how we can very well use the Black-Scholes equation. The major part is either I could use the equation directly or I derive a partial differential equation which talks about the change in the price of the option, using this Itis lemma kind of a scenario. And now the same Black-Scholes model, if at all there is a dividend declared, continuous stream of dividend of Q that is declared. Earlier we have used the formula, the call option price is S naught into N of D1 minus xe power minus RT N of D2. And we said that D1 is nothing but log S by X plus R plus sigma squared by 2 into T divided by sigma root T, and D2 comes out as D1 minus sigma root T. Even the put option we have brought it out as xe power minus RT N of minus D2 minus S naught into N of minus D1. Now if at all there are dividends that are existing, the whole scenario is going to be more or less one and the same, except for instead of S naught, wherever there is S naught mentioned, I'll take it as S naught. I'll take it as S naught into e power minus qt. So probably the call option price is going as S naught e power minus qt nd1 minus x e power minus rt nd2. So this is what is coming out whenever there is a continuous stream of dividend declared. So even here the D1 comes out as log, if I am taking it as S by X itself, here I am taking R minus Q plus sigma squared by 2 into T by sigma root T. And D2 I will take it as D1 minus sigma root T itself. So this is what is typically operating out whenever we are using the continuous stream of dividend. Otherwise there is nothing much of a change in the formula. So this is how a Black-Scholes formula can very well be used for pricing the call option as well as put option. If you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.